To add to your points there, also, we're not seeing, you talked about the amount of capital, the time requirements to bring on an enormous oil field. And we're not finding a new Guar, a new Cantarell in Mexico, Guars in Saudi Arabia. We're not finding these giant oil fields that are low cost, that have enormous wells, that pay back quickly. The return on energy invested, the capital costs are enormous to find future oil production, and they take many, many years. A lot of them are deep water, and the shale wells, those deplete very, very rapidly. I think within 3 years, they deplete or over 90%. I think they're enormous depletion, but there's just not a lot of supply side investment. We're not seeing a lot of new mines come online, even though the copper price got close to $5 a pound. Bringing a sizable copper mine online takes many, many years, could take a decade and over $1 billion of investment. So the supply is not going to come online quickly. And then OPEC, with the energy point here, we'll stay on energy for a little bit longer. Just the OPEC data, Lyn, that's come out in the last 12 months. I mean, OPEC has every incentive to grow their oil production right now, to grow natural gas production. And if you look at the data from them raising their production quotas, they're just not meeting them. The OPEC plus countries are missing their production quotas by over 2 million barrels a day, and it just keeps getting worse. So even though they're officially raising the production quotas, they're not actually producing more oil.
Yeah, there are some people like Josh Young that have been covering that pretty frequently and kind of calling it ahead of time, which is basically saying that they think OPEC's spare capacity is less than consensus thinks. And I think that the data is making that credible because, like, as you pointed out, they have every incentive. Normally the incentive is the opposite. They try to produce more than they're allowed to kind of sneak in a couple extra barrels. And of course, right now we're seeing that many of them are unable to meet those quotas, despite the fact that prices are this high, and it's kind of several countries are looking at it as like a national emergency. And another point I'd make is that both China and the U.S., so the two biggest economies in the world, two biggest oil consumers, are both taking steps to basically reduce oil prices. So the U.S. is drawing down a strategic petroleum reserve, and China has these like multi-month lockdowns. This past couple months, and if you look at flight data, for example, they have they've crushed their their driving and their flying industries back down to what they looked like in the worst parts of 2020, and so China is basically, whether it's related to energy prices or not, or their political infighting, whatever their causes are to do this level of lockdown that they're doing, they are reducing China's oil consumption significantly at the moment. And so these high prices we see right now are despite the fact that the two biggest oil consuming countries are, the U.S. is adding supply to the market, and China is pulling demand off the market, and these are the prices now. So if we get to a period where the Strategic Petroleum Reserve is no longer able to pull down, and if we have some degree of China reopening, those are two upward forces on oil prices that would have to be offset by either new supply coming online or demand being destroyed that badly elsewhere. And so that's why I think that although they can probably hold prices down for a period of time, there's no clear end in sight in the next few years to have any sort of cheap energy, other than in the depths of a really, really severe economic crisis. And some of the other things that they could do is have more nuclear and have more things like that. But those are also very long lead time projects. So our LNG terminals, pipelines, these take a lot of capital expenditures. And the price of doing all that is much higher now, of course, because you have some labor wage inflation. The parts to build all that stuff has it generally inflated. The transport costs and the construction costs are all higher. And so I think that basically this is a longer term issue than the market thinks. And I think that we could have a situation where they get oil price down temporarily. The market's like, oh, look, it's transitory. But then as soon as they have some sort of stimulus again, then it just shows right back up.
And then it's a rally similar to what happened in 2020, where you have a mini crash, very painful for a short amount of time, maybe 12 months, 18 months. And then there's an enormous rally. And this volatility is just going to absolutely blow people's minds, because 2 years ago, people were paying record low for gasoline prices here in the United States. And now the swing in 2 years, now they're paying record highs. If they can find diesel, I mean, there's shortages now of diesel. The U.S. is still exporting the stuff, gasoline, diesel to Europe. It's a mess. It's bad policy, though, because you were tweeting out yesterday about Germany's bad policy for nuclear power. I mean, they can't get the natural gas right now that they need. They didn't build liquefied natural gas the facilities there to have that. They can't bring in the coal quickly, and the green energy ESG people don't want that. And then they are shutting down nuclear power reactors. I think France is also at like a 20 or 30-year low for the amount of nuclear power that they're generating inside their country.
Yeah, it's really, managing to optics rather than outcomes. And it's kind of, now they're kind of paying the price for that. And there is when I started talking about uranium back in 2020, I was citing this like research study. I think it was actually by the National Bureau of Economic Research here in the US, but they were talking about Germany's energy situation. And they basically estimated that, they Germany could have reduced their coal usage if they had not shut down their nuclear power, right? So they could have taken off, they could have significantly reduced what is basically the dirtiest type of fuel to have, keep more of their existing clean fuel. So they basically made the least green choice they could do by taking off their nuclear and leaving their coal. It's also challenging because nuclear takes much longer to build than coal. And so now they're the whole European continent really is paying the price for this, not just in Germany but elsewhere. And they don't really have a lot of great outcomes at the moment, and that's why they're stuck doing rather weird policies while they're in the middle of an inflationary crisis. So there's so much debt in the system that the ECB, for example, has to monetize Italian bonds, despite the fact that inflation is officially in the high single digits, and energy price inflation looks like a Weimar chart.
And natural gas prices in Europe are even higher than natural gas prices here in the United States. And we're recording this interview on Monday, June 20th, 2022, for our listeners out there who want to know the date, because I always get asked that. But these natural gas prices, these energy prices, Lyn, this is affecting food too. This is affecting fertilizer. This is affecting food. Then these governments have these protectionist policies now. It seems in the last 6 to 8 months, I think it started with Russia in February. They banned fertilizer exports. And then a lot of these other countries started either started banning fertilizer exports or banning wheat exports and other staple crops. So do you think this food crisis and this energy crisis is exacerbating the food crisis as well?
Yeah, I think so, because it's obviously a key input for fertilizer, and just in general, farming is a very energy intensive process. Not a lot of people realize that. And so energy costs have direct implications for food costs around the world. And when the pie is not growing, countries get more combative. They get more protectionist. At worst, it can turn into kinetic wars, and at best, it's just trade wars, things like that. And now the U.S. is considering export bans on diesel, and so basically, a lot of the disinflation, the disinflationary trends we had over the past 25 years were from opening up of global trade. And basically geographic arbitrage. So if you look at a chart of oil price spikes, like let's say 5-year rolling, like how much oil went up or down over 5 years, and you do the same for official CPI, so 5-year rolling number. So it filters out the annual noise. It's actually kind of these longer trends about inflation and oil prices. Throughout history, they've generally been very, very correlated. If oil price spikes, that contributes to a CPI spike. It's kind of the key driver in that. And the one in the 2000s was the one exception where you got this huge oil price spike, but in the developed world, you didn't really see a lot of inflation. You had pretty mild inflation in that decade compared to what you'd expect from looking at that oil price. And it's in large part because we export a lot of our inflation to China and the rest of the developing world, where a lot of our marginal workforce was basically popping up in those countries. And so we weren't getting the type of domestic wage pressures we'd normally see in that type of high oil price environment. And so we were able to kind of detach ourselves from that last oil price spike. But now, because of deglobalization and because Chinese demographics have pretty much peaked out, and so they're no longer this gigantic, like unlimited sink for global labor, I think that this oil price spike is going to translate into more persistent CPI problems, and also just obviously real inflation behind however they want to calculate the CPI. The other ways of trying to measure broad segment of prices. I think this could be a bigger problem for developed, the whole developed world than it was in the 2000s decade.